Hello, this is the CEO of Weisenbach Investments, and this is just going to be a basic Elliott wave review of all the major markets. So, this is how I look at the Elliott waves done by a computer. I prefer to do Elliott waves on my own and draw them out on, say, TC2000 or Thinkorswim. But TradingView is actually where I can look at the Elliott waves that are generated by a computer. So let's get rid of the computer Elliott waves. Look at them a little later, but I want to draw out my own. Like that. Okay, here. So let's just start. So right here, the uptrend in prices didn't really start till right here. So I'm gonna think that's gonna be wave one. Well, actually, it's likely that the whole section is gonna be wave one. So this is wave one. It actually kind of looks like a wave 3, but I don't like to break the rules in the Elliott wave. So this is going to have to be wave 3, wave 4, and then this is wave 5. And then actually, I said at first that I thought this was an ABC correction pattern right here. But it really wasn't. It was, but only to break the wave 5 trend. The real ABC correction is right here. And we haven't gone to wave C, but this is obviously wave B. Now, we're seeing some pretty strong resistance around this level, and I have TC2000 open, so you can look at the SPY. Let me move this over. And on a 1 minute chart, so obviously the S&P 500 is seeing some resistance, and it's just bouncing around. Let's look at the pure S&P 500. And I got short around here. Just let me check something. Let's look at the chart of the future also, because that's what we were looking at before. I think I have it under here. Okay, here it is. Okay, so I got short in here, taking a little bit of a loss, but this is more of a swing trade because I was basing it off the hourly chart. So this, the ES looks like a good chart. It's seeing some resistance. Plus, it's looking like it's getting to the end of the Elliott wave pattern. Anyway, so here's our uptrend. So this uptrend is obviously broken. And really what the trend's gonna look like is it's like this. Now, if you look at, there's an Elliot wave in here, a smaller one. So remove. Okay, so in here, we're also gonna take a look. So this to me looks like a wave 1. And we have wave 2, wave 3, 4, and wave 5s can be pretty complex. And wave, this is actually almost an ABC correction pattern, but right here in this area, but it's not because the trend is continuing upward. An ABC correction is only when the trend has broken to the downside. And obviously here it broke to the downside, but this was a small or ABC pattern of the 5th Elliott wave and only the 5th Elliott wave. Because within an Elliott wave pattern, there are always Elliott waves within that pattern, unless you're looking at, say, just little tiny few ticks. And there can even be an Elliott wave traced in here, but like if you look at 1 tick, 3 ticks, there's not going to be any Elliott wave pattern in those ticks because there's not enough room. So we're gonna probably see an ABC correction here. I expect the S&P 500 to break to the downside. And actually, this is a good website to share your thoughts on. Weisenbach Investments is just as my. But I want to. Oh, can't do that, so we're gonna have to look at the SPY. Okay, so the SPY obviously gets gaps up, gaps down because of the movement after market hours from the E-mini S&Ps. But this is showing also that the SPY's topping out, and let's look at the QQ. So NASDAQ's topping out. I forgot the Russell ETF, but actually even emerging markets are topping out. Safe place to put, if you look at a swing trader perspective, the only safe place to put your money is a bond ETF in bonds. And I'm just going to look at the bond future. Now, longer term, I think bonds are going to go down, but obviously swung up. I think they're going to see a little downturn in the short term, but longer term, bonds are becoming kind of a bubble. Now, we haven't seen a real ABC correction pattern. This is not one because it didn't break its trend. So we're going to see ABC correction pattern somewhere in here. You see, actually, bonds are extremely correlated to stocks. Like, as you can see, they did almost nothing and actually kind of shot down in the 2011 crash period. So bonds are not as safe as most people think they are. They can actually be quite volatile. So anyway, so now let's look at I want to look at it. We're going to look at the computer's Elliott wave. So the computer is essentially also saying there's an ABC correction. Here's what the computer said. They thought this was spike up and this was 2. And here's why I don't like the computer, because it sometimes breaks the rules of Elliott. But there's a very large wave 5. So what the computer's essentially saying is this is a wave 3, but there's not much more room for it to go up. So I would say this is more, and also this is breaking Elliott rules, because wave 2 is not supposed to retrace more than wave 1. So this is why I don't like the computer's Elliott waves, and I prefer to draw out my own. But let's, I'm just reviewing the major markets, so let's look at the QQQ Trust. And we don't want that. And let's make volume invisible. There. So, actually the QQQ Trust behaves in almost the same fashion, but actually this is a wave 1, because wave 2 did not break wave 1, and then this is a wave 3, wave 4, and then here's a big wave 5, and this wave 5 is powerful. And the NASDAQ actually shows what institutions are doing really well. Oops. Because the NASDAQ markets are, and Russell's is much more dominated by institutions than individuals, and a lot of the E-mini S&P 500 movement is just individuals playing around in the market. So I'm more interested in what institutions are doing, because they're the people who make the market move. And obviously I'm not interested in the individuals, because it's not baby boomer money. And baby boomers, their money is not trading actively unless they're in something like a long-short mutual fund. And I really do not like mutual funds. I'm rather against them. So, you see, if we looked at the QQQs, they would know this is a fake out ABC, because it didn't retrace very much. So this has to be the ABC pattern. But here's how we would look at it. Right. So it's unlikely that we see ProShares get to 67. Very unlikely, because, or same with S&P, it's unlikely that they get to. Some people think it's not gonna. It has to get to 142 to start retracing. I'm a little against that, because if you look at the S&P 500 short fund, it says it's at a important resistance, and it's not. It can't really. It broke this resistance, but it's unlikely to go down. because there's no downside movement. And you can see this is just the opposite, exact opposite of what the SPY or the S&P 500 is going to do. So I need to, give me a sec, I need to find the Russell ETF. I don't remember what it is. Okay, I'll get it for you in a minute. But while that's waiting, let's just kind of review of what the overall market's doing. So here's my watch list. And okay, so S&P's up 6 points, Dow's up 67, S&P futures are up 4, bonds are up 1/4 of a point. Corn has retraced back from its resistance level, is down 7.5 points. Gold is up, and oil is up. Okay, here, we've loaded. And let me find this. Okay, so we need to look at IWM. Okay, so this is the Russell, and I should actually bring up, should bring up Trading View to take a look at the Russell. Sorry about the delay, I couldn't remember what the Russell was. So obviously institutions definitely think the Russell's selling off. They really don't like the Russell, and small cap growth. A lot of the Russell's small cap growth. And of course, small cap growth does very, very poorly in bad markets. So let's take a little bit of a look. So wow, that's a huge #1 wave. I've never seen anything quite like that. Well, okay, I have. Just that's a really, really large #1. There's #3, and then here's 5, and fake out ABC. I just call these fake outs because they're real small and they're not the real ABC pattern fake out. And then we have this real large ABC. And in the Russell, we're actually in wave C, starting to make a little bit of a recovery because we're on a resistance level. Did not break it. Well, it kind of did, but not really. And then it took a nice little bounce to the upside. And this is actually another small resistance. It broke it. This isn't a real important, but if you're looking at this kind of time period, there. So you can see that's definitely resistance. And it showed some resistance here and some resistance there, but not much. It was more of a support over here, but it proved itself as a resistance, and this proved as a support. So once it breaks this support level, I'm actually not a fan of shorting on the support level, but if the price is too high, like very high, over a period of time, and it breaks the support, great short. But when you're at the bottom of the market and it breaks the support level, it's not time to short at all, because they almost always rebound off those bottom stocks. Almost always, in bonds and any other market, almost always will rebound off a really low support, like right here. That's an extremely low support. They shot down after that support, and you could take advantage of that. Look what they did. If you held one more day, you would have lost everything if you got in around here. Almost everything. And that wouldn't be a good trade. So I prefer those high probability, high support breaks, not low support breaks. So if the stock's at a 52-week low breaks, it's 52-week low. If the fundamentals believe in it, if the company's good enough, if the market's having a good fundamental picture, there's two things stocks do. They either bounce around, and that's usually when they're pathetic, until the market finds value, or they rebound off their lows, and obviously markets rebound off their lows. Now they bounced around here because there's no reason for fundamentals to show any reason for the markets to go up, but there's not a terrible amount of news for it to go down. So here's our good news, here's our bad news, here's our good news, and that'll be easier to look at with an area chart. See, good news, bad news, good news, bad news, good news, bad news, good news, bad news, good news. Part of this is the market just simply sees value, and you can see that. The way I think of technical analysis is it's the market showing value, not fundamentals showing value. So obviously the market saw value off these levels, so because it kept bouncing up. I'm more of a fundamental guy, and I like to see value. I really don't like trading based off technical indicators, because right here, here's the thing. If fundamentals validated it, this movement to the upside could break this, and go up. But that's unlikely, and that would be an extremely large ABC correction, huge ABC, and then there would be usually some reason that the markets would take. But I would not trade that level if there's some fundamental reason against it. Now there's not. Fundamentals are terrible. Economic fundamentals. I'm a macro trader. I like to trade all macro trends. And this right here is a really good resistance. It could break a little bit, but after that break, I would definitely short. Like, for example, if the IWM got to 80.19, that would be a great short for me. And if I had to, if it got real volatile, I might buy a strangle and then sell off the call, and if it goes the call way, sell the call at a good level, like say it gets to 81.26, or it shows signs of going higher, which it most likely won't. But I would sell off the call and hold just a long put. Well, that's all I have to say for today. Thank you for listening. This is CEO of Weisenbach Investments. We provide customized financial investment newsletters, specifically on trading by a weekly time frame, and we do some investing also. We also released a new strategy called the Global Macro Strategy, and I write a newsletter based off what I've decided I want to trade in my paper portfolios, and I may also trade these. I often do have the same ideas in my real portfolio, but this is exactly what I would want to be doing in the market. Sometimes I can't trade things in my real portfolio because I already may have money tied up in some other trade, and that's mostly the reason why I wouldn't do a certain type of trade. But this, I recommend exactly what I've decided I would want to be in the market on Monday. The newsletters are likely to be sent out Saturday or Sunday, and I work on them for about a week, and then I send out what I want to be in for the next week to you guys, so you guys can see. But anyway, it's the same price that all the normal newsletters are. Well, thank you for listening. If you want to learn more about us, you'll find us at Weisenbach Investments.webs.com. Thank you.